Ever feel like you're just, drowning in information? Like there's this constant flood of stuff you should know, papers, reports. But who has the time? Well, that's where the deep dive comes in. We're your shortcut. We take all that complex info, boil it down, and give you the important bits, the surprising stuff, so you can actually be informed without the headache. Today, we are plunging right into the deep end. We're talking finance meets quantum computing, specifically something called Autocallable options pricing. Sounds intense, right? Our main guide here is this really interesting academic paper, Classiq Autocallable options pricing with integration-based exponential amplitude loading. It's by researchers from places like Intesa Sanpaolo, Classiq Technologies, Fondazione Links, and Politecnico di Torino. Quite the lineup.
Yeah, and our mission really for this deep dive is to unpack just that. How is quantum computing actually being used or proposed for a very specific, very tricky financial problem? And we want to highlight what looks like a really significant step forward here. It could genuinely change things.
Okay, let's unpack this then. You mentioned financial derivatives. What exactly is a derivative, just for a quick baseline?
Right, okay. So, simply put, a derivative is just a financial contract. Its value is derived from something else. That something else could be stocks, bonds, commodities, currencies, you name it, an underlying asset.
Okay, derived value. Got it. And options are a type of derivative.
Exactly. And the key thing with options is they give the holder the right, but not the obligation to buy or sell that underlying asset. There's always a specific price, a specific date involved.
Right, the choice factor. That makes sense. And I've heard of different types, like European and American.
Yeah, the main difference is when you can exercise that right.
Yep.
European options, only on the expiration date. That's it. American options are more flexible. You can exercise them anytime before they expire.
Okay, and payoff. That's just whether you make money or not.
Pretty much. If exercising the option makes you money compared to the market price, that profit is the payoff. It's in the money. If it doesn't make sense to exercise it, the payoff is zero. It's out of the money. Simple as that. So now we get to autocallable options. These are, well, they're a big deal in structured finance. They let investors get these really tailored risk-reward profiles, super popular, billions traded. But, and this is the kicker, that complexity, that customization, it makes them really computationally expensive to price correctly.
Okay, so what is it about them specifically that makes them so complex? Why are they harder than, say, a standard European option?
Good question. It boils down to a few key features. First, they can be based on a single asset or on multiple assets, like maybe tied to the best performing stock in a basket or the worst performing one. Already adds complexity, right?
Multiple moving parts.
Exactly. Second, and this is really crucial, they are path dependent. This means their value isn't just about where the asset price ends up. It depends on the path it took to get there. Performance is checked at specific dates, like checkpoints, over the option's life.
Ah, okay. So it matters when things happen along the way.
Precisely. It creates these multiple observation periods where things can trigger a payout. Third, the payouts, often based on the return of the asset, not just the price. And it's calculated as a fraction of some notional value, basically the overall size of the deal. Fourth, they usually involve a series of binary options.
Binary meaning, like on or off.
Exactly. You get a fixed payout if a certain condition is met on one of those check-in dates. If not, you get zero for that date. And if one of these binary options does pay out, boom, the whole contract usually ends right there. It's auto-called.
Hence the name, autocallable. Makes sense.
Right. And then often there's a sort of safety net for the issuer at the very end. It's usually a short knock-in put option. This only becomes active at the final maturity date if none of the earlier binary options paid out. And if the asset has dropped below a certain barrier level, the original buyer might actually owe the issuer money. It adds another layer of conditional risk.
Wow, okay. That is intricate. I can definitely see why pricing that would be a headache. You've got multiple assets, path dependency, conditional payouts.
You nailed it. Modeling the probabilities of all those correlated assets moving together over multiple time steps. That's where classical computers really start to struggle. It's a huge computational load.
So how do people typically price these things now using classical methods?
Well, the foundational model is often black school's. You probably heard of it. Nobel Prize-winning stuff. But it makes assumptions like constant volatility that often don't hold true in the real world, especially for these complex products. And it only gives you a neat formula, a closed-form solution in pretty limited cases.
So not ideal for autocallables then?
Generally, no. So the go-to alternative for complex cases like this is Monte Carlo simulation. Basically, you simulate thousands, maybe millions, of possible future paths for the asset prices. For each simulated path, you figure out what the payoff of the autocallable option would be, discount it back to today's value.
And then you just average all those results.
Exactly. You average all those discounted payoffs to get an estimate of the option's fair price.
It sounds kind of like brute force in a way. Lots and lots of calculations.
It is. It works, but it's slow. The accuracy improves with the square root of the number of simulations, which is written as 1m. So to double your accuracy, you need to quadruple the number of simulations. It gets computationally expensive fast.
Right. And that leads us perfectly into quantum computing, the promise of a faster way, maybe.
That's the hope. Quantum computers excel at certain types of problems that are just intractable for classical machines. And finance, especially derivative pricing, is seen as a prime area where they could make a difference.
So what's the quantum magic trick here?
Well, it's not exactly magic, but it's clever. The core advantage comes from an algorithm called quantum amplitude estimation, or QAE. Remember Monte Carlo's convergence rate, 1 or Elmer? QAE potentially offers a quadratic speedup. Its convergence rate is theoretically 1n, where n is roughly analogous to the number of Monte Carlo paths.
Whoa. Okay, so 1n instead of 1 over root m. That sounds significantly faster.
It could be, yes. Potentially far fewer quantum computations to get the same level of accuracy, like upgrading from that brute force averaging to a much smarter sampling technique.
How does it work conceptually for pricing derivatives?
Generally, there are two main phases. First, you need to encode the probability distribution of the asset paths onto a quantum state, load that information into the quantum computer. Second, you perform the payoff evaluation. You design a quantum circuit that calculates a discounted payoff for those paths and encodes that value into the amplitude of a specific quantum bit, a qubit. Then, when you measure that qubit, the probability of getting a certain outcome, like 1, is directly related to the expected payoff you're looking for.
Okay, that's the goal. But this isn't the first attempt, right? People have been working on quantum pricing for a while. What were some of the earlier approaches or hurdles?
Oh, yeah, there's been a lot of work. Early research focused on simpler single-asset options. A big challenge that popped up quickly was how to handle the financial data itself. You often work with log returns, but you need actual returns for the payoff. Converting between them using quantum arithmetic turned out to be really resource-intensive, needing lots of qubits and operations.
So the overhead of just doing the math quantumly was a bottleneck.
Exactly. Some researchers then came up with smart ways around it. One group proposed using pre-trained circuits to load the initial distributions. Another group used something called quantum signal processing, QSP, to directly encode the payoff function, trying to avoid that heavy quantum arithmetic altogether. They showed pretty big resource savings, like fewer gates, fewer qubits needed.
Sounds promising. Any drawbacks?
Well, some methods, while clever, maybe affected the overall scaling or introduced issues with how the final result was normalized, which could impact accuracy. It's been an iterative process, finding the right balance.
Which brings us to this paper. They're building on one of those previous methods, the integration-based one, and proposing an enhancement.
Precisely. They identified a specific issue with an earlier integration-based amplitude loading method. The problem was that its normalization factor, think of it like a scaling constant in the calculation, became inefficient, or excessive as they put it, when the range of possible input values was limited. This inefficiency hurt the final accuracy.
Okay, so how did they fix it? What's the innovation?
Their key idea is pretty neat. Instead of preparing the quantum state to represent the entire possible range of outcomes, they focus only on the relevant range. They load partial exponential states. By tailoring the preparation to just the values that actually matter for the specific problem, the normalization becomes, in their words, optimal. It wastes less quantum resource, essentially.
So it's like zooming in on the important part of the picture instead of trying to load the whole landscape.
That's a great analogy, yeah. So how it works in simplified terms, they start by loading the standard Gaussian distributions for the asset price movements at each time step, adjust the mean, variance, standard stuff. Then they calculate the log returns, and critically, they apply all the comparisons needed for the autocallable conditions checking barriers for the binary options, the put option, while still in the log return space.
Ah, so they avoid converting to actual returns at that stage.
Exactly. They sidestep the expensive quantum arithmetic for that conversion. Instead, they use this improved integration amplitude loading technique to effectively encode the payoff based on those log space comparisons.
Very clever. Does this structure offer any other advantages? You mentioned parallelization earlier.
Yes, that's another benefit. The part of the circuit that prepares this special exponential state can actually run in parallel with other calculations. Only the comparator parts, the bits that check the conditions, need to run sequentially. This parallelism can significantly shorten the overall runtime of the quantum algorithm.
Okay, parallel processing is always good. Now, the paper talks a lot about t-depth. Why is that specific metric so important?
Right, T-depth. It's crucial because in the context of fault-tolerant quantum computing, which is what you'd need for calculations, this complex certain quantum gates, called T-gates, are much, much more costly to implement reliably than others. They require more resources, more error correction overhead. So minimizing the number of sequential T-gates, the T-depth, is a major goal for making quantum algorithms practical. It's a key indicator of how long the calculation will take on future hardware.
So less t-depth means a potentially faster and more feasible quantum computation.
Exactly, and this is where the new method really shines in their analysis. They compared their improved approach to the previous state-of-the-art, like that QSP-based method we mentioned, using a specific example, say 20 time steps, 3 assets, aiming for an error around 2 by 10, 3. They found a dramatic reduction in the t-depth needed just for the amplitude loading part.
Dramatic how? Give us the numbers again.
Okay, so the previous integration method they were improving upon. That amplitude loading part had a t-depth of roughly 2100. Their new method brought that down to about 40.
40 from 2100.
Yeah, it's a massive drop. So the bottom line is this translates to roughly a 50 times reduction in t-depth, specifically for that payoff encoding component, compared to other leading methods like QSP.
Wow, 50x. That's not incremental, that's a leap. What does that kind of improvement in one part mean for optimizing the whole algorithm going forward?
It's huge, actually. It means that this specific step, the amplitude loading, is suddenly much less of a bottleneck in terms of t-depth. It shifts the focus. Now, the biggest gains in t-depth reduction for the overall algorithm might come from optimizing other parts, like how you initially load the asset distributions or how you handle the risk-neutral measure. It opens up new avenues for research and makes the whole prospect seem, well, a bit more attainable.
Okay, this sounds theoretically fantastic, but we don't have large-scale, fault-tolerant quantum computers just lying around. How did they actually test this? What about real-world validation?
Great point. And yeah, you're right. The hardware isn't there yet for these kinds of circuits. They have too many qubits, need too much coherence time, so they had to rely heavily on simulations running on classical computers. Powerful ones, mind you. They mentioned using the default Classiq simulator, NVIDIA simulators on GPUs, even the Leonardo pre-exascale supercomputer in Italy.
Using classical computers to simulate quantum computers. A bit ironic, but necessary, I guess.
Absolutely necessary at this stage. Now, the gold standard for validation would be to run the quantum algorithm and compare its output directly to a traditional Monte Carlo simulation. But since the full quantum circuits were too big, even for the simulators, they used a really clever workaround.
Which was?
They built classical models that were specifically designed to mimic the limitations of the quantum algorithm. Think about things like how the quantum algorithm approximates the smooth Gaussian distribution with discrete steps, or the limited precision it uses for calculations due to having a finite number of qubits.
Okay, so they created classical test dummies that had the same constraints the quantum algorithm would face.
Exactly. They compared the quantum simulation results against 4 different classical calculations. 1, just standard Monte Carlo. 2, Monte Carlo but using the same discrete approximation for the Gaussian distribution as the quantum algorithm. 3, a direct calculation, closed form where possible, but again with that same discretization. And the crucial one, number 4, a closed form calculation using both the same discretization and the same fixed point arithmetic precision as the quantum model.
And what did that fourth comparison show?
That was the key. The results from that fourth doubly constrained classical model matched the results from their simulated quantum algorithm, using a technique called iterative QAE or IQAE within the expected margin of error.
So it validated that the quantum circuit behaves as expected, given those inherent quantum limitations.
Precisely. It showed the logic was sound under those constraints. And furthermore, they showed that as they increased the number of simulated precision qubits in those constrained classical models, the results got closer and closer to the ideal unconstrained results. This gives confidence that as quantum hardware improves and we can allocate more qubits to precision, the quantum algorithm will converge to the correct answer you'd get from traditional Monte Carlo, just much faster.
That's a smart way to validate. But it also highlights the current challenge, doesn't it?
Oh, absolutely. They state that Even for quite small examples like one asset, three time steps, two binary options, the quantum circuits generated are still considerable in size. We still need those big simulators for now.
Okay, so let's wrap up this deep dive. We've seen a really novel quantum approach for pricing these complex autocallable options. The big headline seems to be this improved integration-based exponential amplitude loading. It's not just a small step. It delivers something like a 50x reduction in t-depth for a key part of the calculation. That's pretty remarkable.
It really is a significant improvement for that component. But, as we discussed, the challenge remains the overall size and complexity of these quantum circuits, even for simplified problems. That's the bottleneck now. So, future work is pretty clear. Further optimization across the entire algorithm is needed to shrink those circuits, then testing on actual quantum hardware, probably using sophisticated error mitigation techniques since full fault tolerance is still a way off. And of course, extending this approach to handle even more realistic financial models like those with more complex volatility structures. There's still a lot to do.
Definitely. So here's something to chew on as we finish. We just heard about a 50x improvement in one part of a complex financial calculation thanks to a quantum technique. If that's possible, what other seemingly impossible problems, maybe in finance, maybe in drug discovery, material science, you name it, might quantum computing unlock down the road? What possibilities stand out most to you?